Hi guys, welcome to my show MKJ Talks for Investment in English. Today we will be discussing the second important principle of investing, and that is diversification. Diversification is the second most important principle. The first principle was buy cheap, sell expensive, and the second principle is diversification. You know, when you are doing long term investment planning, when you are saving and investing in markets to earn long term profits, then there is a need to diversify your investment. You should never invest all your money in stock market. Are you getting my point? You should never invest all your money in equities. Instead, you should divide your investment into equity mutual fund and debt mutual fund. The reason being, because returns from equity mutual fund, they are unpredictable, but returns from debt mutual fund, they are predictable. Good debt mutual funds will give you return around 8 to 9.5%, 8% to 9.5%. So you go for those funds, those debt funds which give you assured return somewhere between 8 to 9.5%. Now, I'll explain you the entire concept. This diversification will not only help you apply the second principle of investment, but it will also help you applying the first principle of investing. I'll explain you how. The first thing is, first concept of the first idea under diversification is don't invest all your money in equity. Invest 50% in equity and 50% in debts. And the second is don't invest all your money in equity in one equity and all your money in debt fund into one debt fund. When you're investing in debt fund, invest your money in at least 3 to 5 debt funds. And when you're investing your money in equity market, I will suggest you, invest your money in Nifty indexed mutual fund. That will give you the best diversification available in equity market. Why? Because when you purchase units of Nifty 50 mutual fund, you basically invest in the top 50 companies of India. Because Nifty index comprises of top 50 companies in India, and when you are investing in the related mutual fund, your money automatically gets invested into the best 50 companies of India. So this way you will be able to diversify your money and minimize the risk in your portfolio. And automatically you will be able to follow the first principle of buying cheap and selling expensive. I will explain you how. Suppose today the index is at 10,000 and you enter market with 2 lakh rupees. I'm again explaining. Today index is 10,000. The chart will come at the top. You can see the chart also. You intend to invest 2 lakh rupees and the index is 10,000. So you invested 1 lakh in debt fund and 1 lakh in equity mutual fund. 50-50. Right? Now, suppose market crashes and the index falls to 5,000. What will happen? Since you have invested in Nifty 50 index mutual fund, your investment will also fall proportionately. So the amount you invested in equity, that is 1 lakh, will become 50,000. Now, what is the value of your total portfolio? 50,000 is the value of equity mutual fund and 1 lakh is the value of debt mutual fund. So total becomes 1 lakh 50,000. Again divided by 2, 75,000, 75,000. Now what you do? You redeem 25,000 rupees from debt mutual fund, bringing your debt mutual fund from 1 lakh to 75,000 and invest the same in equity mutual fund, taking up your equity mutual fund from 50 to 75,000. Now you have 75,000 in equity mutual fund and 75,000 in debt mutual fund. Again 50-50. Total is 1 lakh 50,000. Right? Now suppose, now we will imagine the market rebounds. The market start rising and it reaches back to the same level, the original level of 10,000. So from 5,000 index rise to 10,000. What will happen? Your investment in equity will double because you have invested in Nifty index mutual fund and index has doubled, so will your investment in equity mutual fund. So you invested 75,000, now they will become 1,50,000. Now what is the value of your total portfolio? 1,50,000 in equity mutual fund and 75,000 in debt mutual fund. So the total comes to 2,25,000. Now see, you started when the index was 10,000 and today also the index is 10,000. There is no change in index, but despite no overall change in index, you have earned 25,000 on an investment of 2 lakhs. That comes to 12.5%. And we have not taken into consideration the rise in the value of your debt mutual fund, because debt mutual fund will also give you a return of around 9%. So if you add that return on your debt mutual fund balances, so your return, overall return of 12.5% will definitely become somewhere around 17%. Now see, the overall return which index gives is how much? 15% in long run, 13 to 15% in long run, but you have earned how much? 17%, and you are enjoying the liquidity also. Your risk is also less. Why? Because you have invested only 50% money in equity fund and rest you have invested in debt fund. So when people say just keep on buying equity, you will earn a good profit in long run, it is not true, because it will depend at the time when you have entered in the stock market. Because if you started your investment when markets are at peak, it will take decades for you to show reasonable return. I am telling you, this is a fact. You know, share market is the most misleading market in the world. They will give you distorted data. I have so many people who have been investing in small cap mutual fund, large cap mutual fund on the basis of SIP for the last 2 years. I ask them, what is your return? Most of them tell me that their funds have fallen by 20 to 25%. But when you will go to any mutual fund site, you will find that 1 year return is hardly minus 3.5%, minus 6%. But those guys who have invested into SIP, they have lost around 30 to 40%. Reason being, because the returns which these mutual funds show, they compare 2 point of times. 1 point 1 year ago and the other point today. So they compare these 2 points of time to calculate the return. But in case of SIP, you are investing daily. So when the markets are rising, then also you are investing. When markets are falling, then also you are investing. So you never earn good profits. In this technique of diversification, whereby you are balancing between equity mutual fund and debt mutual fund in the ratio of 50-50, automatically you are following the first principle. When the market fell down from 10,000 to 5,000, you bought equity mutual fund. And when the market again rebound from 5,000 to 10,000, you sold equity mutual fund. So you are automatically trading in the stock market without any burden on your head. You have not to find out which company is good, which company is bad. You are just trading on the main mutual fund index. When it falls, you purchase. When it rises, you sell. Automatically you are doing it. How much you have to sell, how much you have to purchase, that is also being done automatically. You are not letting your emotions go into it. You are allowing the mathematical formula to take control of your investment. And I'm telling you, if you will follow this concept, you are bound to make millions and trillions in stock market, depending upon how much you invest. Obviously, if you are not investing much, what I can say in percentage terms, you are bound to earn somewhere between 14-15% to 20-25%, depending upon the fluctuations and volatility in the stock market. Let me summarize everything. In short, what you have to do is, you have to invest both in debt mutual fund and equity mutual fund. This will give you both type of diversification. First, you have diversified your money into risky and non-risky areas. Secondly, when you are investing in equity mutual fund, especially Nifty index mutual fund, you are investing in 50 companies. So you have completed your diversification. This was the first part. The second is, you have to maintain the balance of 50-50 between debt and equity mutual funds, between equity mutual fund and debt. So whenever market will rise, your value of equity mutual fund will rise. You sell equity mutual fund and shift the money to debt mutual fund to make both 50-50. And when the markets fall, the value of equity mutual fund will fall. you redeem debt mutual fund and shift the money to equity mutual fund. If you follow this concept in principle over a long period of time, you will find that you will earn huge returns more than what normal people earn by investing in SIP by investing through SIP in equity mutual fund. This is my assurance. I think you have understood the concept. Got it? Hope you have enjoyed my video. If you have enjoyed, please share my video with friends and like my video, subscribe to my channel, and I will come by with another video in my next show. Thank you. Bye bye.